when websites with no money became worth billions. Imagine getting rich without making a single dollar. But before we get started, make sure to like this video and subscribe to the channel so you don't miss any new content. At the turn of the millennium, a new kind of gold rush swept across global markets, not for land or oil, but for websites. The internet, still in its early days, promised to transform everything from shopping to communication. Investors, driven by excitement and fear of missing out, began pouring money into any company with a .com in its name, regardless of whether it made a profit. Stock markets reflected this frenzy. The Nasdaq Composite Index surged to unprecedented heights, fueled by technology startups that had little more than ambitious ideas and sleek websites. Traditional financial metrics, such as revenue, earnings, and cash flow, were often ignored. Instead, companies were valued based on website traffic, user growth, and future potential, metrics that were speculative at best. Among the most iconic examples was Pets.com, an online pet supply retailer that became famous for its aggressive marketing and sock puppet mascot. Despite generating significant publicity, the company struggled with a flawed business model. Shipping bulky pet food at low prices proved unsustainable, and losses mounted rapidly. Yet, during its initial public offering, Pets.com was valued at hundreds of millions of dollars, at times appearing more valuable than established profitable businesses with decades of experience. This disconnect between valuation and reality was not limited to one company. Venture capital flowed freely, and startups burned through cash in pursuit of rapid growth. Investors believed that market dominance would eventually translate into profits, even if no clear path existed. The phrase, "get big fast," became a guiding principle, overshadowing prudent financial management. By early 2000, cracks began to appear. Rising interest rates and growing skepticism forced investors to reassess their assumptions. As confidence faltered, stock prices started to decline. What followed was a swift and brutal correction. The Nasdaq lost nearly 80% of its value over the next 2 years, wiping out trillions of dollars in market capitalization. Companies that had once been celebrated as pioneers collapsed almost overnight. Pets.com became a symbol of the excesses of the era, shutting down less than a year after its IPO. Many investors, from seasoned professionals to everyday individuals, suffered significant losses. The dot-com bubble left behind a powerful lesson. Innovation does not eliminate the fundamentals of finance. Sustainable businesses require viable models, disciplined spending, and realistic valuations. While the internet ultimately did transform the global economy, the path to that future was far more volatile than many had imagined. In hindsight, the madness of the dot-com era was not just about technology, it was about human behavior. Optimism, speculation, and herd mentality drove markets to irrational extremes, reminding investors that even in the face of revolutionary change, financial discipline remains essential.